investment advisory services offered through Alpha Capital Management, LLC, a SEC registered investment advisor. Alpha Capital Management, LLC, and SWAN-Capital are independent entities. Welcome to What Your Money Would Say. I'm your host, Andrew McNair, and for the next 30 minutes and the weeks to come, every Saturday from 12:30 to 1 o'clock here on WCOA 1370, I will be your retirement expert. My goal is to help guide you through the unknown rocky terrain that lies ahead in retirement. I started SWAN-Capital and What Your Money Would Say because I believe in what SWAN stands for, sleep well at night. I started in this industry because I was sick and tired of seeing families get rocked by financial crises like 2008. Too many families were blindsided, not because the market fell through the floor, but because they were investing like they were 20 years younger. And remember, when the tide goes out, you find out who is skinny dipping. So my goal here at What Your Money Would Say is to help you sleep well at night financially. And so I'm excited about today's theme, where we're going to talk about ETFs and mutual funds. And I'm bringing back Eric Bjorklund from Alpha Capital Management, who talked about asset allocation last episode. But before I do that, I want to share with you some upcoming events we have here locally. And remember, you can always call at 850-478-3116. That's 850-478-3116. If you have any retirement planning or estate planning questions you want to run my way. But the Veteran Benefit Project, my nonprofit organization, has a workshop coming up on veterans benefits at Westminster Village out there in Spanish Fort, Alabama, where we're going to teach families how they can learn up to receive up $24,000 a year from the VA to help pay for assisted living and home health care expenses. So if that sounds like something of interest to you, give us a call at 850-380-5137. That's 850-380-5137. And also, I'll be talking on my third book, Tithe a Living Testimony, at Heritage Baptist Church tomorrow, Sunday at 7:30. So I hope to see you there bright and early. And as always, you can like us on SWAN-Capital Facebook page and check us out at swan-capital.com. But I have some news articles I want to talk to you about today, and that is the life insurance mistakes that retirees make. And the first one that just really gets me on my soapbox is no plan. That's number one. See, when I sit down with a client and I ask, okay, we're going through a financial plan, and one of those pieces is your protection components. Let's talk about your life insurance plan. I say, Mr. and Mrs. Client, what is your life insurance plan? They say, well, I own life insurance. I got $250,000 a group term, but I know when I retire, I might lose that. And I said, well, let's stop there. So we know you have $250,000 of life insurance, but what's your life insurance plan? Well, they say, Andrew, I got life insurance. Well, I know that, but it seems like everyone just buys things, but we don't have a plan that surrounds it. And I sad to say, it just seems like everything's just sold to us, but we don't have a plan that surrounds it, that says why we bought this and what's it intended for. Again, people buy things without having a plan. And also, how do you implement it? Because when you pass, when you're not participating with all of us, when you pass away, who's going to help your wife or your spouse go through that process of help paying off debt, if that's what you want to do, or investing in and making sure that she has an income she can never outlive? Here's the thing is, a lot of, if your advisor may be the same age as you, you got to think 20 years in the future when actually that life insurance pays out. Will he be there with you to help guide your family through that? I don't know about you, but my goal is to be the last financial advisor you ever have. And I have the youth to be able to do that. I'm just getting close to my prime over here. So if you suffer with not having a plan, my goal at SWAN-Capital is to help give you that plan, not just sell you something, not just say, well, here's some life insurance you can buy. How about a plan that when it's implemented will make sure that your family is protected and leave a legacy that you'll be remembered by. The second is a myth of self-funding, or not enough, basically. A lot of families say, well, once I have, $500,000, $1 million, you remember that retirement number, that I don't need life insurance. Well, that's not necessarily the case all the times, because unexpected things can happen. You never know if, God forbid, you got a car accident with your wife, and you might, take the easy way out of this life, but she suffers with a lot of health care things. And that $500,000 can get eat up by a nursing home or an assisted living. So you want to make sure that you have enough insurance. You just don't own $200,000 and say, well, that pays off the mortgage. It's not that simple. The number third is buying the wrong type for the wrong situation. There's plenty of people that say, well, buy term, invest the difference. No, you don't buy term and invest the difference. You're crazy. You're losing out on lost opportunity costs. You need to buy whole life insurance. Both are right. See, the problem is too many people have their own cookie cutter advice. Life is, again, never that simple. Every financial plan is different. You need custom advice. Sometimes you can't cash flow whole life insurance. You need term to fill that gap. But if you can have the cash flow, sometimes whole life makes a lot of sense. I like to think about it as a surgeon. Sometimes a scalpel is a great tool, but if you're trying to, cut open a chest, it's not the right tool. You might need a bone saw or something like that. So you need to have the right tools. I mean, we all have a toolbox. You just need to pull out the right tool. The next one is the permission slip. See, if you have enough life insurance, you'll have the permission slip to spend some of the assets that you wouldn't normally would. The prime example is reverse mortgages. Ooh, that sounds like a bad word. A lot of people have a lot of bad things to say about that. But it can actually be a great tool for families that have a lot of built-up equity but don't have a lot of income they need in retirement. But they say, well, Andrew, the reverse mortgage sounds great, but if I did that, I couldn't give my house to the kids, and that's a family heirloom, and I want to give that to them. Well, life insurance gives you the permission slip to be able to spend down that asset, and then when you pass, be able to buy it back. Also, it gives you the permission slip to spend other assets that you earmark for kids. Like if you say, well, I have this IRA that I'm not going to touch. I'm going to let my kids have that when I pass away. No, go have a vacation. Go spend it. Go live life, knowing that when you pass away, that's going to be replaced. And the fifth one, and this is very important, settlements of your life insurance. Too many families just check the box on the settlements of their life insurance, and people are completely unaware. If you were to get in a car accident and the life insurance car accident that you pass in, and they send the check to a money market account in your name, and you're still in the middle of a lawsuit, that's assets that those attorneys can go after. You don't want that to happen to you. Also, beneficiaries, you got to watch out for that. A lot of times, we set up an ex-spouse and we get divorced and we don't think about it, and 10 years later, it becomes a real nightmare at probate. So you don't want that to happen. You don't want these mistakes to happen to you. If you want someone to actually sit down and give you a second opinion, we can do that. At SWAN-Capital, give us a call, 850-380-9558. That's 850-380-9558. All right. I am looking forward to bringing on Eric Bjorklund back again. Last week we were talking about asset allocation, and this time we're going to talk about ETFs versus mutual funds. And this is a great segue because ETFs are a great way to solve that asset allocation problem. So I want to welcome back Eric Bjorklund.
Thank you, Andrew. Happy to be back. Again, my name is Eric Bjorklund. I'm with Capital Management. We're an SEC-registered investment advisor. So what that means is we are an asset manager. Essentially, we work with advisors like yourself and help manage your clients' assets on their behalf. We're really uniquely positioned in that you have these terrific client relationships and understand the client's needs, and you're able to then communicate that back to us, and we have a staff of professional asset managers who then, in turn, construct and manage portfolios for the clients, really trying to match up their risk tolerance with one of our various models.
As an investment advisor, I have to choose who I want to use as a money manager, because what I can promise you is you can't do it all. As a financial advisor, you can't manage client relationships, you can't manage clients' funds, and build strategies to help them out with college plan, retirement plan, and estate plan. You can't be a jack of all trades. So I specialize in bringing my clients the best client experience and crafting strategies specific to them. But I weigh a lot and lean a lot on people like Eric to help manage the assets of my clients. Eric, would you kind of share with the listeners what's the difference between Capital Management and some other money managers?
Well, I think what really separates us is the people that we end up working with. Ultimately, we're very selective in the advisors we work with. Just as you took your time and did your due diligence to find a firm that you wanted to manage your clients' assets, we're making sure that our advisors have Well, there's the legal fiduciary responsibility that I think we're going to talk about a little bit. But, we want to make sure we're identifying advisors who have a shared set of values and really are going to work with us and allow us to be an extension of your team. Like you said, it's difficult for one individual to play every single role and kind of be a man against the world and fighting for someone's financial future. And so the role that we play is you have that client relationship and can best understand the client's needs, and you in turn are able to turn over the asset management to a team of experts and allowing each of us to do what we do best.
That's a good way to put it. And I like the key word you said is team. And I consider y'all a part of my team as a financial planning team. Again, a lot of clients I see try to, break up their financial plan. They say, well, I'm going to go to my insurance person. I'm going to go to my investment guy. I'm going to go to my long-term care specialist. What I'm trying to do is be the head coach. But another thing you talked about, Eric, was fiduciary duty versus, just a suitability standard. Could you go into more depth about that?
Absolutely. As the license that you and I both hold, the Series 65, as it's called, that actually holds us to a legal standard. It's the fiduciary standard of care. And again, that's written in the law. That's in black and white. And what that means is that anything we do really needs to be in the client's best interest. That's not to say it can't be mutually beneficial, but any action we take, any investments we recommend, need to be in the client's best interest. The flip side of that coin is what's called suitability. There are some folks in the financial industry that are held to a suitability standard. Doesn't mean they're necessarily doing anything wrong. However, it doesn't quite have that same impact as the fiduciary standard of care. I like to illustrate the difference between the two as saying you need a new car just to get to work. You can go out and buy an economy sedan. Maybe you find a Kia or a Hyundai, something like that, where it's a low-cost vehicle, gets good gas mileage, isn't going to cost you much at the pump, and sure, it's going to get you to and from work. You could also go out and buy a Lamborghini. It will also get you to and from work, might cost a little bit more, probably get you to work faster.
Sure.
But, again, either would be considered a quote-unquote suitable mode of transportation. Now, in our world, what we really would need to do is dive into the client's finances, understand, can they afford that Ferrari or Lamborghini, or is the Kia more suitable, or something in the middle of the road maybe? We need to really match up the client's goals, their situation, understand what they're trying to do and accomplish, and act accordingly. And we're legally held to that standard.
I'm joined here with Eric Bjorklund from Alpha Star Capital Management, and we're just about to dive into what's the difference between ETFs and mutual funds. Eric, can you share with us, some of us have heard of what a mutual fund is, but if you'll start off there.
Sure. A mutual fund is they've been around a long time. I think most folks probably have at least a general understanding, and without getting too crazy deep into it, what a mutual fund is it's gives an investor the ability to purchase a basket of goods with a single share. So, you can go out and you can buy a share of Coca-Cola, or you could buy a share of Google stock or Facebook or anything like that. But then you're having to buy each individual share, or you could buy a bond as well, or anything along those lines. What the mutual fund does is you buy a share of the fund company, so there's closed-end and open-end. Again, we don't need to go down that road. But what you're essentially doing is you're taking your investment and purchasing a share of many different things. There's a fund manager who's directing what's going to be bought in this big aggregated pool, but then you're able to buy into that pool, essentially.
Right. And most people buy mutual funds for the diversification. Just because you have your money in a mutual fund doesn't necessarily mean it's diversified. You might be totally in domestic stocks, and if the whole domestic market goes down, well, you might not be as diversified as you thought. But thank you for starting off with what is a mutual fund 101. I always love when Vince Lombardi, that quote where he says, "This is a football." Before we make it too complicated, let's start with the basics. Now, we know what a mutual fund is. Now, what's an ETF?
An ETF, that stands for Exchange Traded Fund. These are relatively new, and I say relatively. I believe the first ETF was available in the United States in 1993, so going back 20 years. And again, it has a similar philosophy in that it's allowing you to purchase into a pool that has ownership of many individual securities. They can be stocks, they can be bonds, they can be shares of commodities, physical gold and silver, things like that. So there's some alternative assets in there as well. Kind of what separates them a little bit is that where a mutual fund is kind of designed around a prospectus, and an investment manager has a kind of a stated goal, what he's trying to achieve with the mutual fund. An ETF, an exchange-traded fund, is typically trying to track an index. One of the index that we probably know about, and actually it was built around one of the first ETFs, is the S&P 500. Most folks have heard about that, and so what the ETF that engages in the S&P 500 does, basically buys one share of each position that's on the S&P and tries to track that index over time.
Now, if they're tracking the index, and some of the great advantages of ETFs, not always the case, but it can have lower fees. But again, a lot of people are just unaware of what fees they're paying in general. That's why I always push families to say, hey, let's do a fee audit. Come into SWAN-Capital, and what we'll do is we'll compare your statement, and we'll kind of, take a deep investigation into what fees you're paying. Not necessarily to beat you up or beat the financial advisor up that's managing your portfolio, but to bring transparency, because I think there's power in clarity. And so if you'll talk a little bit about the fee differences in mutual funds and ETFs.
I think that's really important. Again, nobody's saying fees are necessarily bad, but understanding what you're paying and what you're getting for it, I think, is, like you said, that puts the power in the hand of the investor and lets them make an informed, educated choice. Mutual funds have a variety of fees. There's a 12B1 fees, which kind of handle distributions and some other things. They pay the investment manager. We just kind of lump them all into what we call internal expenses. Internal expenses are going to come out of the daily returns. So what that means is you don't actually see it. Andrew, when you and I have a client, we might have an advisory fee, and the client's going to see that right on their statement. But with the internal expenses, these are coming out of the daily return. So it's decreasing by some extent the performance of the fund.
And those are typically harder to find because we're not, in the daily movement. And you shouldn't be, daily watching your portfolio, especially when you're retired. But those are how those internal expenses can really sneak up on you because you're not daily watching it. Most people see the front load and the back load fees they're paying, but internal expenses can really eat away at some of your returns. You say, well, Andrew, I did really good in 2012 and 2013 compared to what you potentially could have if you weren't treading water with fees.
Exactly, and that's where, again, some have higher fees, some have lower fees. We kind of refer to that as being more or less efficient. Again, it's not that they're necessarily bad if it's meeting your objectives and your investment goals, but you really should know what they are. You can find that data, but the average investor really isn't in tune. And it can take a bit of digging, a bit of work. You can find that on Yahoo Finance and things like that, and you can find the internal expense ratios. That can be Greek to a lot of folks. What we try to do is really be transparent, explain what fees they're paying. Again, nobody's saying they're bad. That's how I make my living. But, it's just good, and we feel much more comfortable when people understand what they're paying, exactly where their money's going, and what they're getting in return. We're
joined by Eric Bjorklund from AlphaStar Management. And today's show, we're talking about ETFs versus mutual funds. Eric, can you kind of share with us fees versus value and how that ties into having a fiduciary duty?
I would almost relate it more to the transparency and just making sure people know what they're paying and what they're getting. One of the reasons that we at AlphaStar Capital Management chose to build our portfolios based on ETFs is that they do tend to have a lower cost. That's for a couple of reasons. One, I mentioned earlier that the ETFs are typically trying to track an index. So since you're tracking an index is fairly fixed, there's not a whole lot of transactions within the fund. With a mutual fund, however, that can be a very different story, depending on the fund, of course. Some are very actively traded. What that can do for you is, one, increase the internal transactional costs. It costs money to go and buy and sell stocks, bonds, and things like that on the market, and so those costs are absorbed inside the fund.
Trading
With the
costs.
ETF, there tends to be less turnover. That also leads to another thing, tax efficiency. When you have this turnover, which is what we call buying and selling, is turnover. You're selling one thing, purchasing another, or leaving it in cash, whatever the case may be. If you have any short-term gains, a lot of us know short-term gains are taxed at your ordinary income tax rate for the most part. So there can be some taxable gains in a mutual fund, those tend to be reduced. Again, we're kind of speaking in broad general terms here. Those tend to be reduced or at least very much lower in ETFs.
Active management versus non-active management. Just set and forget it. What's the pros and cons there?
The set it and forget it, the old buy and hold strategy. There's certainly something to be said for that. For one, it's going to reduce your transactional costs because you buy it once and you sit on it. And so that is a good thing. It also means, how do you know when you should be getting out of something? A lot of folks don't have a disciplined exit strategy. You know, I bought my shares of Google. Well, when's a good time? Oh, how about Apple? Apple's a great one. You know, Apple's been a real strong performer up until recently. It's lost a lot of its value. Is it going to come back? Is it not? I don't even pretend to pontificate on that. But what you can say is it was certainly worth a lot more a few months ago. You know, that's undeniable. How many people sold out of it at that point? A lot of folks don't have this strategy in mind of saying, I'm going to sell when it reaches X price. What we do with our portfolios is they are actively managed. Now, that doesn't mean we're buying and selling, you know, like crazy every single week, every single day, because we do want to reduce the turnover within our models. But what that does mean is that we do have a disciplined strategy of when we want to exit or at least pare back a given position. If we see an asset class is what we would consider relatively inexpensive to the rest of the model, maybe it's time to invest more of our assets into that underperforming asset because we're doing what's the old adage? You want to buy low and sell high. Again, that active management and our investment strategies gives us a real mechanism. Takes a lot of the emotion out of it.
Exactly.
We don't want to ride the highs and lows of the market, but we want to have a strategy for whatever the future may bring.
Yeah, and I want to emphasize the word discipline. You know, when it comes to having your money, you can be very emotional to, you know, sometimes cut your losses or not be greedy enough to say, well, I push for a couple more percentage points to earn more. But when you have an active money manager, it takes the emotion out of it, and you're just going for a common goal, and that is to, you know, get, you know, some steady returns. As retiree, it's not so much, you know, rate of return, but the return of your principal. And so we try to make sure, of course, your money is always unpredictable in the stock market, but we try to be as conservative as we can. If any of this piques your interest, or you just still don't understand how ETFs work versus mutual funds, and you're concerned about maybe some of the fees you're paying, and you hear from your advisor once, twice a year, you're trying to say, is that fees equate to the value I'm receiving? Well, what I'd love to encourage you to do is schedule a fee audit. Come into SWAN-Capital, and what we'll do is we'll sit down with you. We'll sit down with your portfolio and do an investigation to see what fees you're actually paying. And again, we're not trying to beat you up or beat any advisor up. We just want you to understand what you're paying because there's power and clarity. I want to thank Eric Bjorklund for coming back on the show.
Hey, it's my pleasure. Thanks for having me, and a very happy Memorial Day weekend to everybody out there. A big thank you for all of those who have served our country, past, present, and future.
Couldn't sum it up any better. Thanks, Eric.
What your money would say. Today's financial landscape can be rough. One of the most important aspects of planning is choosing the right guide to help you navigate the road to retirement. Andrew McNair and the team at SWAN-Capital is dedicated to providing the very best service in the retirement planning industry today. SWAN-Capital is a full-service independent wealth management firm dedicated to providing guaranteed custom income plans that you cannot outlive. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. The difference between SWAN-Capital and you retire once. We help people retire every day. You should be enjoying your retirement years, not letting worry keep you up at night. SWAN-Capital. Sleep well at night. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. Again, that's 850-380-9558.
The Veteran Benefit Project, founded by Andrew McNair, president of SWAN-Capital, is a nonprofit organization dedicated to helping veterans and widows of veterans with long-term care expenses by qualifying for the VA's Aid and Attendance Benefit. Learn how to receive over $24,000 per year from the VA towards long-term health care. There is absolutely no fee associated with our assistance to the veteran, the widow of a veteran, their families, or any retirement community. Our goal is to preserve the dignity of the veteran and to reduce the dependency on the Medicaid system. Again, learn how to receive over $24,000 per year from the VA. Contact the Veteran Benefit Project 850 850-380-5137. That's 850-380-5137. 850-380-5137. Look us up on the web, veteranbenefitproject.com. At the Veteran Benefit Project, we are committed to helping you secure the benefits you deserve.
Retirement expert Andrew McNair. Changing the retirement paradigm. Now back to what your money would say. Brought to you by SWAN-Capital.
Welcome back. Well, I hope you enjoyed that interview with Eric Bjorklund, where we talked about ETFs and mutual funds and what the differences were. And as always, if you missed our interview talking about ETFs and mutual funds, or you missed the last week where we talked about asset allocation, we have all those shows recorded at swan-capital.com under the Get Educated, under the radio show. You can listen to them as much as you want. Again, if you have any questions about retirement or estate planning and you want to talk to someone local, I have a phone number to call, 850-478-3116. That's 850-478-3116. And you can get me here at WCOA 1370 on What Your Money Would Say and ask a personal question about retirement planning and estate planning so you can get some non-biased advice to some of your questions. Also, I want to recap what we talked about prior to our interview with Eric Bjorklund. And those are about the life insurance mistakes that retirees commonly make. And the first one is no plan. So if you're out there and you have life insurance or you have group term and you know that when you retire you're going to lose that group term and you're wondering what your life insurance needs are, and you want a real evaluation, call us at SWAN-Capital, 850-380-9558. Because when you retire, again, it takes a different specialist. You can't just continue going to your general practitioner and get expert advice when it comes to retirement planning. You need someone to sit down with you because if you're selecting survivor benefit, do you select survivor benefit? Do you have enough insurance to support it if you don't select survivor benefit? Because the last thing I want to see is another widow that their husband didn't elect survivor benefit, or they did and they didn't have enough insurance to protect them when they passed. I'm tired of seeing that financially. The second is self-funding, the myth of self-funding, not having enough insurance. 3 is buying the wrong type for the wrong situation. 4 is having a permission slip to spend down your assets. And 5, beneficiaries and settlement. Also, I want to just take a moment and thank the military for all that they do, because being a Navy brat of my grandfather, seeing the sacrifices they've made, traveling from Hawaii to Maine. The Hawaii part didn't sound too bad, but traveling around the country to make sure our freedoms were protected is a priceless sacrifice. So I thank the veterans for all that they do. Be sure you don't miss our next show. I'm very excited to bring on Dr. Rick Harper at the Office of Economic Development over at University of West Florida. Next week's theme is going to be retiree economics, where we're going to sit down and talk about economics for the retiree and how you need to protect yourself in this uncertain environment. Again, also we have a Social Security class coming up at PSC and UWF this June and July. So check us out at swan-capital.com for those upcoming dates. And remember to check us out on Twitter, and you can drop your questions either on Twitter, on Facebook, or give us a call at 850-380-9558.